and serve groups all across mostly Southern California, but we expand into San Luis Obispo and a few other areas. We're hosting over 30 events a month right now since we've moved online with COVID. I'm not saying it's been easy, but we have been able to still continue to have community programming. If you'd like to support us, please become a member of our organization or consider a nice fat donation with all of that saved money from Phil's advice. And I can tell you how to do that, and you can through our website as well. We're not going to waste your time with a bunch of announcements, though. We want to hop right into it. So I'm going to read a quick bio to introduce my friend Phil, and I will give him the floor. So Phil Ferguson, you might know as the host of the popular show, The Phil Ferguson Show, very well named. He has been sharing his insights and expertise on skepticism and investing and a million other topics for a number of years now. Phil's been an investment advisor representative since 1996 and is the president of Polaris Financial Planning LLC. He's also a longtime activist in the secular community and secular movement. He's been on the board of the Secular Student Alliance, Atheist Alliance International, and has served as treasurer for the Reason Rally in 2016. He's an active member of many national freethought organizations and has helped start 3 local groups as well. You've seen him if you've been to a lot of national conventions at TAM, which is called The Amazing Meeting, and at Skepticon, just to name a few. With that, I want to give the floor to Phil Ferguson on his topic today, which is skepticism and investing, index funds, and other fun ideas.
Thank you very much. That's very kind of you. Yeah, it's a love of mine, secular world, and pushing back on the favoritism of religion. And it just so happened I would go to a lot of conferences and I would donate money to conferences. And one of them many years ago said, "Hey, do you want a table?" I was like, "A table? What the fuck does a finance guy do with a table at a atheist or secular convention?" Oh, by the way, I swear. So hopefully that's okay with everybody. I said, "Okay, sure." I get a table and did a conference, did 3 conferences, did 5 conferences. My peak year, 1 calendar year, I did 14 conferences, atheists, skeptics, humanists, secularists, free thinkers, whatever, something that someone couldn't do today because it's not possible, but had great fun with that. And I'm hoping someday soon we can meet in person again and have more contact. I have some prepared slides and I have even more we can choose from later, but I can also take questions. So I'm just kind of go wherever you guys want to go. So I guess this is a good time to share my screen. Let's see. This is so cool, but yet so many choices. Hopefully you all see a purple slide with Polaris Financial Planning on it.
Yep.
And Evan, how are they supposed to ask questions in chat or?
Yeah, if you can put as many into chat as possible, and then I'll try to jump in if I see a good one, or I'll try not to cut you off much, but yeah, I will feed the questions for everyone.
Because now, since I've shared my screen, I don't see the chat.
Perfect. We'll keep an eye on it for you.
Yep. Awesome. So let's see how this works. Does it work? There we go. Kind of today, the focus is investing skeptically. And by that, I mean how to avoid getting ripped off with investments. One of the things I do regularly on my show and when I give presentations, I really see myself first as a consumer advocate. So I try to teach people how to invest. I teach people how not to get fucked with investments, do all kinds of things like that. And what happens eventually is someone who listens or sees me present somewhere contacts me and I get a client. But the driving focus for 25 years, oh my God, 25 years has been helping people do better with their investments. And one of the ways I do that is with the podcast, the Phil Ferguson, the cleverly titled The Phil Ferguson Show, available in any and every good podcast player. I think we'll call that the true podcast player Scotsman rule, whatever, because if it doesn't have my show, it's not a good podcast player. I teach people how to money. It's one of the phrases I stole. Someone else came up with it, not me. And basically, you have to save money. And I regularly get calls or emails from people that said, I don't make enough to save money. What do I do? That's not my show. I don't really know. I know that many years ago, my wife and I were at a point in our lives where we had more debt than income in a year. And I've been there. That sucked. I don't want to ever be there again. The second part, of course, is to invest well, invest wisely. And the third one is time. I do not have any clever get rich schemes because I don't think they generally work. It's bad advice, I think. Not only do I call it investing skeptically, but sometimes science-based investing. And by that, I mean, I do a lot of studying of the research. There actually is research done in investing and how it's best to invest and what's the best way, the most efficient way, the most tax efficient way, how to mitigate risk and volatility. But the problem is those people are in universities, kind of like little ivory towers. And then the vast majority of the industry are salespeople who their primary goal often is to sell you some shit and they make money from that. What I often tell people is the salesperson may or may not know about the product they're selling you. That's not their job. Their job is to not understand it. Their job is to sell it. So that's what they get paid to do. Going to do some housekeeping stuff. Polaris Financial Planning is a registered investment advisor. I am registered in the state of Illinois and also in Texas and California. So I do have to fill out paperwork with the California government. I don't like it. They are pains in the ass. Since 1996, as you said, I'm glad that matched. This information is for educational purposes only. This is not investment advice. It is definitely not personalized investment advice because I don't know all the details of your situation. Of course, consult with your own financial advisor before taking any action. What else do we got here? Past performance does not guarantee future results. And then we've got a cute cartoon to signify a segue. And so here's Ted with his always accurate post-market predictions. And this is something that's very common in the investing world. The things that you will be recommended to purchase or buy are things that have already done well, but they might not do well going forward. And that's a very common problem with the investment world. So you have to try to figure out how to invest wisely, not with what's hot. So the first segment I'm going to have is about index funds, and I'm going to talk about those for a little bit. But before I get into that, I'm going to assume that your average level is not particularly high. I hope not to bore you, but we'll go through the basic stuff really quickly. When you're doing stock investing, you could buy stock in a specific company like Apple or Tesla or Enron. And the problem with buying a stock, one company, is you could make a killing, like if you bought Tesla 4 or 5 years ago, or you could lose 100% if you bought Enron at the wrong time. So one of the ways to reduce dramatically specific stock risk is to buy many stocks. Today, it's much easier and much cheaper to buy small amounts of stocks. So you could do that more on your own than you could in the past. But even then, it can be a little expensive, a little difficult to buy a lot of stocks. And one of the things that's weird is when you look at what's called the guaranteed risk-free rate of return, which is calculated by very short-term US government bonds. In any given month, only 4% of stocks account for all the difference between the risk-free rate of return and the theoretical 10% from the stock market. So most stocks don't do particularly well. A lot of them go down, and it's a math trick, but the modal return for the average stock in the US stock market is minus 100%. And almost every company eventually goes to zero, but it may not be in your lifetime. But a lot of stocks do fail. A lot of companies fail. Mutual funds, you can buy a mutual fund and they will do that for you. They'll buy 20, 50, 100, 500, 1,000 different companies. And the more individual companies you have in your portfolio, either on your own or through a fund, reduces your specific stock risk to the point where you've virtually eliminated that risk. But then, like I said, it can be very expensive. A lot of mutual funds are 1 to 1.5% published expense ratio. On my show, I often do a segment called a super shitty fund, where I come across a fund that is absolutely horrible. And often they are presented to me by people inside the industry that have figured out that I have a business and that I have clients, and it would be a great thing for me to sell their shit to my clients. Usually I tell people things like, please forward a check for $5,000 to receive further consideration. Or I will send them a thing saying, FYI, anything else that you send me despite your footer saying it is private information available only to me, I will completely ignore and disregard that if you send me any more content and make it publicly available in any means of my choice. And they go away. But every once in a while, they keep sending me stuff. So poof, I have a segment on a super shitty fund as an example. I was talking about expense ratios, and here's some of the things that can be in the expense ratio. You can have 12B1 fees, which is an additional fee to help compensate the salesperson to sell you the fund. So you're paying part of their commission to sell to other people. And when this law came up, the original idea was that it would make the funds cheaper for everybody. Of course, that never happened, and the industry just made more money. So there's a lot of things that can go in that expense ratio. What a lot of people don't know is that the published expense ratio for any given mutual fund does not include every expense that you pay. It only includes all of the categories that are legally required by the regulation that requires them to publish an expense ratio and include things in it. There are things that are not included. One of the examples is trading activity. So if you have a mutual fund that does a lot of trading, buying and selling the stocks or bonds in a rapid manner, it drives up the trading expenses, and it can be a way for them to make money and to charge you and to pass on all of those expenses without raising the published expense ratio. So there's always another way to trick you and to separate you from your money. And of course, people can do research, and they look at funds that have done well in 1, 3, 5, 10 years. You can also look at Morningstar for their 5-star rating system. The sad thing is all of that information is practically worthless. Matter of fact, the Morningstar 5-star funds, I say, are a slight negative because most people will think that those ratings have value and buy based on that and then end up underperforming going forward because something changed in the market. As an example, in 1999, all of the 5-star funds, or a lot of the 5-star funds, were high-tech funds, companies investing in things like pets.com. And they were all 5-star because they had huge returns because we had a bubble, and they got 5 stars because they had huge returns. Well, a couple of years later, you look at almost every one of those funds and they were 1-star funds. So it's a historical look at some mathematics. It's not really valuable, and it may actually be contra valuable. I'm going to talk a little bit about some stuff that's in a white paper from Vanguard. You may have heard of Vanguard. They're the second largest mutual fund company in the world. I think they're just slightly behind Fidelity still. And this one was called Quantifying the Impact of Chasing Fund Performance. Of course, you can take a picture of the screen if you want with your phone, or make a note, and you can go find this document yourself. It has a lot of nice graphs, charts, data. Vanguard makes a lot of really high quality white papers where you can learn more about how the industry works. I'm going to talk specifically about some large cap funds from 2004 to 2013 here. And I stole this graphic, I guess, from that white paper. And what it's showing you here for large cap growth funds over the time period that was on the previous slide, the index funds, where if you just bought and hold everything, returned 6.8% per year after inflation. And the average managed mutual fund made 4.5. So you were getting 2.3% less by trying to beat the market. And this is a very common thing. And one of the things index funds do is they match market performance, and no one wants to match the market. You want to beat the market. But the very effort of trying to beat the market almost always in the long run results in you not beating the market, and you would have been better off just matching the market, keeping your cost and taxes low. And I'm going to go over that a little bit. Of course, the taxes, if you buy and hold, if the mutual fund that you own buys and holds, you might pay taxes of 0% on your gains. If your income is low enough, the capital gains tax rate is 0. So if you buy something for $10,000 and hold it for 10 years and then sell it for 20,000. And if your income is low enough, you would pay zero taxes on all of your gains. Dividends along the way, you'd have to pay taxes on. And a neat trick, a lot of stock and particularly a lot of stock dividends are now classified as qualified dividends. And it's a new rule that helps rich people make a lot of money off of stocks and pay lower taxes than you do for working. Just one of those things, I guess. Again, the capital gains up to 15%, as long as your annual income is below $501,600. So this is a case where if you're wealthy, you can make 2, 3, 4, up to 500,000, and you're only paying 15% tax because you made your money from investments. Whereas someone who works for a living will pay 22, 28, 32, 35, 37%. Maybe 37% is over 500,000, but it's in that ballpark. So again, it creates a situation where wealthy people who make money from their assets, pay dramatically lower taxes than the average working person. I would like it to all change. I just don't have that kind of power. We talked about trading costs. A lot of managed stock funds have a turnover of 85 to 130%. And so what that means is if they own 100 stocks in a year, they might sell anywhere from 85 of that 100 to 130 of the 100, which means they bought 100, they sold 100, they bought some more, and they sold 30% more again, all within 12 months. And when that happens, an actively managed fund, you no longer get to take advantage of the lower tax rates that the wealthy get. You have to pay income tax rates, and MFJ is married filing jointly. And anything over 81,000, you are going to pay 22% up to a current maximum of 37%. So I'm sure if you had a choice, you would rather pay 0 than 22, and you would rather pay 15 instead of 37. There have been times in the past where capital gains tax rates matched earned income tax rates. That is not today. So one way to lower your taxes is to not have turnover. You want buy and hold. And it's such an easy concept that a lot of people skip over it because it sounds too easy. It's too stupid. So you want to try to do that when you can. Some information about possible results. The average stock market return is about 10% before you include inflation, but it does include the dividends that you get paid. And of course, almost no year is anywhere near average. Last year was 18.4% as measured by the S&P 500. A couple of years ago, it was minus 5%. 2008, it was minus 37%. So there's a lot of volatility year to year, but in the long run, 10% is a pretty good guesstimate. Unfortunately, as you saw from that graphic that I had before, the average fund underperforms the market because they buy and sell at the wrong time, just like you might do. You might buy a hot stock and then it goes down. And you buy a stock that's down and maybe it goes up, but maybe it goes down in your trading costs. The average investor, even using mutual funds, gets a return of around 5.7% because often people are sold mutual funds by their advisor, or you get a mutual fund that's hot. And so you put money in at the top instead of buying a mutual fund that's out of favor, instead of using highly efficient index funds. And of course, the taxes also take a bite. So while the market makes 10 and you think, I don't want 10, I want to beat that, by thrashing around, it's kind of like being in quicksand. What happens is the more you try, the harder you try, the more taxes you pay, the more trading costs you pay, the higher expense ratio that you pay, you end up with less and less and less money. And it results into a situation like this, where this is a graph of investing 10,000 one time only and watching it grow as the market grows. But here's what happens when you start to include what the average fund does versus what the average investor does versus your result after taxes. And so I have had, and I will have more in the future, conversations with people that say, yeah, I tried the stock market for 10 years and made almost nothing. Okay, well, it's maybe because you used it incorrectly. Sometimes I'll talk to a new prospective client and they say, Phil, I like everything that you say. Okay, let's put all my money in stocks for a year and try it and see what happens. And for them, I like to quote a very famous poet, do or do not, there is no try. And so investing in the stock market is a lifelong philosophy that one must embrace. If you put in a bunch of money and try, you roll the dice for 1 year, it's a good chance you're not going to be happy. It could be that you got lucky and you had a great year, but some years go down and they go down a lot. And what often happens with people who are very stock market hesitant, you get a situation where we might be in today. We were definitely in it in the late 90s, where it looks like it's so easy. I mean, I could go buy stock in a retailer with a failed philosophy and a failed business model called GameStop because I'm just going to make a lot of money. That's generally not how it works. I mean, maybe you get in at the right time and out at the right time, but it becomes more gambling and not investing. So some information, this I pulled from a Wikipedia page, Wikipedia S&P 500. And one of the things I like to do with investing skeptically and or science-based investing is to allow you to know where I got the information. Don't fucking trust me. Just, look at it, go, that's interesting. Look it up yourself. If you look at just 1 year at a time, one calendar year at a time, I always look at calendar years because if you start looking at different points within 1 year and a different point within another year, you can make the data say almost anything. So I'm looking at only calendar years, and they're available, this information, on the Wikipedia page for the S&P 500 if you like to see big, complicated tables. It's got a great one. The worst single year was minus 37%. That was 2008. The best single year was up 37.58. So this is the problem with trying the stock market. You probably will almost never make 10% in any given year. You're going to make a lot more or lose a whole lot. And if you tried in 2008, lost 37%, and then took out your money, you've done a thing that I just actually recently did in my show, a segment that I got so much wonderful email, how to unfuck your portfolio. And it's a common thing where people get a little scared, like in 2008 or March of last year when the market dropped 30, 35% in 4 weeks. And it seems like the end is near and they pull everything out. And in the case of 2020, it bounced back to where it was in 4 to 5 weeks. But if you thought that the other shoe was about to drop, you didn't ever got back in. And then the market went up, 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 up all of 2000 and still into 2001. And if you just left it alone, you'd now be up 20, 30, 40, 50%, but you sold at the bottom. And now how do you fix it? So I did a segment on that. The other thing to look at is you don't have to look at investments for 1 year, like I talked about. This is 5 years. And again, this is from the Wikipedia page. This is all potential rolling 5-year calculations from 1970 through the end of 2019. The absolute worst that you did in any 5-year time period is minus 2.35% per year. So if you bought at the absolute peak of the stock market, you could have lost 10 or 11 years 5 years later. And that sucks. So these are things that can happen. This is why it's not good for short-term investing. Of course, the best time period was the late 90s, like 95, 96, 97, 98, 99, where you made 28% per year. So if you had $100,000, I think at the end of the 5 years, you might have had something like $400,000 because it's compound growth. Don't expect that. Don't expect the worst loss. And one way to look at this as a longer time period, if you look at 25 years, again, from this data that you can go look at, when you invest for 25 years, the worst performance out of all available rolling 25-year combinations, the worst was plus 9%. The best is plus 17. And you shouldn't expect to get either one of these results because they were the extreme. From 2070 to 2019, that's 30, almost 50 years. So this is absolute worst and absolute best. So it becomes very reasonable if you own the market and not individual stocks. If you have index funds with low expenses, very low turnover, so they don't cost you in your tax bill, even in a taxable account, you can do really, really well. But again, it's a lifestyle choice. It's not something that you're trying the stock market for a year or two. This is a life commitment. One thing that I'm sorry, let me do this real quick. The blue and the red, the blue is the best 1 year, the red is the worst 1 year. And you can see once you go to 5, 10, 15, 20 years, the longer you do the stock market, the more predictable, ironically. It's one of those things that your returns get more predictable with more time based on historical performance numbers of 1 to 200 years of investing in the stock market. But this is from the last 45 years of data. So keep it simple, silly. Only invest in what you understand. And I was talking about, I get emails all the time from people that want me to sell stuff. And sometimes I don't understand it. Yes, I've done this for 25 years and I see things all the time that I don't understand. I don't know what the game is. I don't know how one can make money buying that investment. I can see how the person selling the investment makes money from you, but I don't see how you can make money. And so in the fable, The Tortoise and the Hare, I think of myself as the tortoise. I am giving really boring investment advice. I'm not trying to beat everybody else. I'm just trying not to get fucked and make a reasonable return while I do it. So I recommend low-cost index funds. I recommend you use your critical thinking skills. If somebody presents something to you that sounds too good to be true, it probably is. And there is an endless variety of things that you can invest. And I invest. Well, it's not just my podcast today. You get to see my air quotes invest in things that you're probably never, ever going to make money. And those things are very clever sometimes and they're very tricky. And this is my pause screen. So you can see the Dolomiti, the Dolomite Mountains in northern Italy. And I'll pause if anyone has questions on what I've covered so far. And just so you know, to think in advance, if we have a lot of questions, great, we'll just go over those. I have 3 more different presentations I can go into. One is on annuities and how the math works in annuities. One is long-term care insurance, and is it a good investment? And socially responsible mutual funds are something that a lot of free thinkers, secularists, liberal people love, and I can show you why it's complete shit. But those are ideas. Talk to me.
I got some questions for you, Phil, that people have been sending in. So let's start with it's kind of a question about if the funds are scamming you or not. Can funds buy cheap and then sell the funds at a profit to themselves?
I guess they could. That would be an activity that would clearly be illegal. And of course, one company or mutual fund selling back and forth to each other, not within just itself, is also illegal. Whether that happens, I don't know. I don't think that's a common practice for upstanding, well-run, well-known brand names like Fidelity, T. Rowe Price, Schwab, because they make plenty of money off you doing legal shit. So they don't have to get too creative. You just have to figure out how they're making money, why they're making money, and is it okay if they make some money while you make money? If you decide that that's okay, cool. But yeah, I don't think that's something that goes on normally.
Right. There's a question about the churning of the funds, where there's a bunch of new stocks coming in and out to go up to 130%. And they were curious if funds do that to increase fees.
That's probably much more likely. I think the average fund, I don't know, it's kind of an accidental perk when they're actively managing your portfolio. They might truly, genuinely think that they're buying good stuff and then selling it and then buying other good stuff. But again, with this philosophy of buy and hold, and it takes a long time to make money, real money in the stock market, you'd have to ask, why are they buying stuff to just 3 or 4 or 6 months later to sell it? what the fuck is wrong with their system that they thought something was a brilliant investment idea and then 9 months later think it's shit and they should sell all of it. That should be a really big red flag for you. You can also investigate any investment, almost any investment, mutual fund wise anyway, on a website called morningstar.com. I earlier bashed their star system. Don't look at that. But you can put in the fund that you have. You can put in all the funds that you have one by one, and you can look at the expense ratio. If it's bonds, you can find out the duration, how much effect interest rates would have on your bond fund. You can look at the risk of the bonds. You can look at the mixture of that portfolio. Some portfolios will have stocks and bonds. I'm not a big fan of that because then you don't know for sure what you have. So if a mutual fund says, we'll hold the lowest amount is 20% in bonds, but we might have 80% in bonds. So at any given time, is that a stock fund or a bond fund? Why are you in it? What's the point? And so you lose control and visibility of what you're doing. Other questions?
Yeah, we've got, how do you know if you're doing well? If you've committed for 10 years and fail, you just lost that 10 years, didn't you? That was a question.
Yeah. I mean, it's funny because if you made those 10 years starting on January 1st of 2000, at the peak of the dot-com bubble, the market went down and down and down. It had recovered all by 2006, 2007, but if you left it in at the end of 2008, you lost 37%. So there is a time period for 8, 9, 10 years where essentially over that entire time period, your portfolio went sideways and you made nothing. If you were adding money in every year, like you have a job and you can add in $10,000 or $20,000, 5 or 10 or 20%, you had actually been way ahead. If you are a younger investor, a big, really big, fat stock market drop is the best gift you could ever get because you can buy on sale. One of the ways I try to explain it to people is that if you're in a store and you see, I don't know, a shirt or a sweater or something that you like, and you look at the price tag and it says $100, and you think to yourself, well, that's a lot of money. It's a nice shirt, nice sweater, but it's $100. I don't know. I'll think about it and I'll come back. Well, you get on with your life, you get busy. And it turns out that a whole year later, you show up and that same shirt or sweater is still on the rack, and you look at the price tag and now it's $400. So of course you buy it. No, nobody thinks like that when you're buying a shirt or clothing or cars, but people get weird with stocks. When the stock doubles in price or triples in price, some people now really, really, really want to buy it. And why do they buy it? Because the price is higher. That's crazy. Did the value of the company go up? Is it worth 3 times its price, even though it only went up twice? Or did the stock price just double and the company is really no different than it was a year before? So you should be able to figure out and calculate how much a specific stock is worth. That's hard. That's really hard. And even the average professional can't do it, which is why mutual funds as a whole, managed mutual funds, underperform the market. It's really fucking hard to do.
Let's do one more question, and then we have 2 other questions I think we can save until a little bit later. GameStop or GameStonk, as the commenter put it. What are your thoughts on what happened there?
Well, the really short version is it's not investing, it's gambling. I don't know. I did a whole segment on it and I got a lot of hate, but I'm going to stand by my position that I'm not going to go there. I don't buy any individual stocks, even for myself. And if I did, I would do a lot of research and find out that there was a good company that had a good product, that had a good stream of revenue, consistent over years, and they had a lot of growth opportunity. And that's the kind of company I would want to buy individual shares in. Buying something just because it's hot and everybody wants it. Sure, if you bought it for 20 and sold it for 300, you made a fucking killing. Congratulations. But that wasn't investing. You gambled and you won. I often tell people if I go to the racetrack, horse racetrack, and I place a bet on a horse and I place another bet on another horse and I win twice in a row, and someone could come to me and go, I found a great investment strategy. No, you didn't. You are gambling. You won. sometimes gambling, you can win. But GameStop right now, AMC, all those things, because one of the things that you don't know, and I also get a lot of hate for this, same thing with Bitcoin, you don't know who's gaming the system. And for whoever wrote the brilliant question about mutual funds selling back and forth to each other, which probably never happens, are there some people selling GameStop back and forth to each other? I don't know. How in the fuck are you going to find out? I mean, you're buying it because of an emotion. You want to get in, you want to share the fun. A lot of these forums where you only live once. And then I would be told by so many people that, oh, okay, it's only $100, or I only put in $1,000. I only put in money I can afford to lose. Okay, not to boast, but I'm a millionaire and I still don't know what the fuck that means. I don't have any money I can afford to lose. If it's not shown to me to be a good investment or a good strategy, I'm not interested until you can show me that it is. So my default is to not try new crazy stuff, to not use Robinhood or Betterment, where they gamification of investing. That's not investing. It's a game. A lot of people think that it's a game because it kind of fucking looks like a game. So I don't know, but yeah, GameStop, who's pushing it? Who's buying it? Who's selling it? What's their motivation? Maybe it started as a classic pump and dump, which we know exists. It happens all the time. Someone goes out and buys a lot of shares of a really steep discounted stock, and then they find a way to promote it. And in this case, maybe it was just a pump and dump that linked up with a meme and got out of control. So I don't think of that as investing at all, but that's my thoughts.
And there was a tangent question to that. Do you think this will have any long-term effects on the regulation of hedge funds, Wall Street, retail investing? Like what will happen with all the people?
No, probably not.
Lost their assets.
There's other bigger things that are problems. The one thought that I had was, when people are talking about they have money to lose, if you think the system is rigged, and we can actually have an intelligent conversation that maybe in a way it is, but if you think the system is rigged and you have $1,000 and you don't really know how the market works, and you say to yourself, the system is rigged, so I'm going to throw $1,000 in it to fuck the people that are rigging it, you're out of your goddamn mind. Because if you think it's rigged, you just fucked yourself. You just threw the money into a fire. It's crazy to think that. So one of the motivations is that the short sellers get caught in a short squeeze when the price goes up. Well, the people who are doing short sells professionally know that this is a problem. They know that they could face unlimited losses of biblical proportion. And so what they do is they hedge and they buy calls at the same time they buy the short. So they can control how much money they can make. They can control how much money they can lose. And when the stock gets high enough, they just purchase the calls that they already bought. I mean, they purchase the shares using the calls that they already had in advance, and they have a mechanism to stop their losses, while an average investor who runs in, it's like a Civil War battle. You're going to run up the hill where all the guys are shooting at you. Are you nuts? No, that's a good way to get slaughtered financially. And there were those people that put in 5 or 10,000. It was everything they had, and then they lost 80% of it and they pulled out. And then they'll of course, that person will say, I'm never going to try the stock market again. You didn't really invest in the stock market. You invested in a meme and you got burned.
Cool. Let's keep moving. There was a question that could maybe give you a little direction. There was a question about socially responsible funds. They're like, I'm invested in them. Tell me why I'm wrong.
All right. Is there anything else before I get to that?
There was one question about inflation. Is it truly 2.1%, or do you think Fed policies are going to make it worse?
There is a non-zero possibility that inflation could get materially higher. 2 to 3% is the historical norm for the United States, but in the late 70s, early 80s, it was in the teens. It could happen. From a policy standpoint, we know more about what to do and when to do it than we did in the 70s, I'd like to think. And one of those ways is the Fed can pull in the reins, or what they say, they take away the punch bowl when the party gets too excited, and they could easily change the overnight rate from 0.25 to 1.25 to 2.25 to 4.25 and really put the brakes on the economy. And that also could devastate your portfolio if you have a lot of money in long-term bonds. It's another intricate topic, but when interest rates go up, bond values go down. And a long-term bond, that effect, as measured by a number called the duration, if you have a bond fund that has a duration of 25, if interest rates go up 1%, you could lose 25% of your investment. If they go up 2%, it gets close to 50%. In something, U.S. government bonds, something that you thought was very safe, you can get really hammered when things change. And I'm going to fly through these. Hang on a second, and I'm going to get to all this good stuff that you're missing. Of course, you could always listen to the Phil Ferguson Show, where I cover stuff and other crazy things. Can I jump forward this way? Nope. The socially responsible is near the end. Ignore the annuities. And don't buy an annuity, by the way. That's this too long didn't read version. There's exceptions to every rule, but don't buy annuities. Oh, wait. How's that?
Whoa.
Wow. Anyone know where that's from?
Just because I know you, I'm going to guess Italy.
Oh, you're a smart guy. That is from the Duomo in Bologna, Italy. Of course, that's Satan and long-term care. And again, if anyone wants to learn more about any one of these topics that I'm not covering, you can send me an email, phil@polarisfinancialplanning.com. Oh my God. There's the other pause in the program. Just go, kitty. There we go. Socially responsible mutual funds, also known as socially responsible investing. And that was the rage. That was what it was called 5 years ago. Now, for whatever reason, they call it ESG. It's the same thing. Socially responsible mutual funds, socially responsible investing, ESG funds, where they focus on the environment, social issues, and governance issues. So a fund following one of these ideas, these philosophies, they look at the ethics of a company. They consider the human rights, slave labor, stuff being manufactured in a really affordable place and maybe taking advantage of people that don't have money, damage to the environment, damage caused by the product itself. Is it a gun? I mean, it's designed to kill people. That's what they do. And they might also avoid certain things like gambling or tobacco, alcohol, weapons companies. And I'm going to cover more of why this is, but this is a marketing game. You're being sold something. You're being convinced that you're doing something beneficial. And I am going to go into the reasons why you're not, but it is a growing business. In 1995, there were 55 funds with 12 billion in management. As of 2018, I couldn't find a newer number. There's more than 500 funds, probably 1,000. And the size of the market is 11.6 trillion, again, in 2018. And I know it's way hotter now than it was in 2018. So I can only imagine how big it is. And so anybody and everybody, for the love of crap, they're gonna make a fucking ESG fund because people want to buy it. I mean, these people aren't stupid. It's like, well, this fund's really not going to do anything other than make us a whole bunch of money. So why would we not make one? It's just crazy. So here's some of the ideas, and there's 4 points, and I'll summarize it at the end. But the first one is each fund has different rules. And so if you're going to buy a mutual fund that does the things that you want it to do, you're going to have to do your research. You're going to have to find out what their guidelines are, because they're not all the same. They buy different things. And one of the examples I give here is that one company may avoid Apple stock because they enslave children in third world countries and put their lives in jeopardy or at risk. Another company might say, well, we're okay buying Apple because they provide income to kids and families that would have nothing else to do, no way to make money. So we're actually helping provide economic incentives in really poor countries. Both of those things might be true at the same time. But which rule are you following? Are you avoiding Apple or are you buying Apple? So you've got to know the specific rules of the fund that you buy. One of the funds that I talk a little bit more about is Domini, and they're one of the well-known green funds. And I found this in one of their documents. Domini may determine that a security is eligible for investment even if a corporation's profile reflects a mixture of positive and negative social and environmental characteristics. Almost all of these funds will have some kind of disclaimer like this where they have rules for what they buy and don't buy. But they always have a rule that says, fuck it. In this case, we can buy something that goes against the entire purpose of our fund because we wanna. And it's kind of an out so they can't get sued by someone saying later, hey, you bought this fund. It clearly doesn't match your criteria. Oh, we allowed ourselves to buy whatever the fuck we want. Okay, so that's the second problem. This is the fund if you wanted to research it on Morningstar, DSEFX. I'm not recommending it. I'm giving you the symbol so you could go look it up yourself and find out more about it. Some of them are expensive. They might have a 5% load up front. And some of the really popular ones that are talked about on the TV and the news often have $1 million starting points. And it's a way that they can keep their costs low because they don't have 50,000 people with $1,000. They just have millionaires investing. The results, I'm going to give you some samples for the U.S. stock funds, U.S. only, not bonds, not international stocks. And I'm going to show you 10-year data that I pulled up earlier today on these funds. As an example, there's the TIAA CREF Social Choice Equity Fund, Domini, which we talked about before, Walden Equity, which I included on this list because I had it years ago when I made this presentation, and Weldon got bought by the Boston Trust Company. And there was another fund that I took off my old list because it kept its title, but it changed what it does. And if you buy a mutual fund from a company that you don't know, they can change the goal and the mission of their mutual fund without your consent. I mean, it might actually have bylaws and require voting, but who controls the majority ownership and it gets to vote? It's not you. I mean, sure, you get to vote, but a fraction of a fraction of a fraction of 1%. One of the biggest ones is the Parnassus Fund. And the interesting thing, unlike when I built a lot of this information 5 years ago, when I first made this presentation, right now they actually look like they're doing halfway okay. Because the S&P 500 made 14.06% for the last 10 years. That's per year, by the way, as of today, going backwards 10 years in time. And these funds, the Parnassus, beat the S&P 500, and the other three are only a point or two behind every year. But I thought, wow, that's interesting. And as I was building these and getting information for this, one of them that I looked at more is this Domini. And I looked at the top holdings that this fund has, and it has the who's who of the U.S. stock market: Apple, Microsoft, Amazon, Alphabet, Tesla, P&G, Disney, NVIDIA for computer cards, memory cards, MasterCard, Home Depot. And how are these companies any better than any other companies? I don't know what rule they thought they were following when they bought all these. But the interesting thing is that if you compare this fund to the S&P 500, you may not be making the right comparison, because over the last 10 years, large cap growth funds have done wildly better than large cap value funds. So if I compare this to the large cap growth index from Vanguard, which has a 16.58% return per year, this fund is behind by almost 5 percentage points per year. Now it's hard to see because when you look at 11.92, you think the market makes 10, I'm making 11.92, I'm winning. But the market was 14 some or 12 something, but a fund more like this, an index fund more like this, owning the exact same fucking stocks. I looked at the large cap growth fund. I think it has 8 out of these 10 in it as the largest positions. It made 16.58%. So you're behind almost 5 percentage points per year. Now, so overall, those funds, just a sample that I looked at, made 10 to 12 to 14%. The S&P 500 made 14%. Large cap growth made 16.5. So you're losing a few percentage points every year.
Can you
So what I
explain
normally,
large cap growth real quick?
yeah. Oh, explain it?
Yeah.
At Vanguard and a lot of other companies that have index funds, large cap growth will be probably usually stocks that are in the S&P 500 and are the biggest of the big companies in the United States. All the names you're going to know and recognize are large capitalization stocks. And then the S&P 500 can be broken up into two parts, bifurcated. There's the word for the day, bifurcated. And there are value funds, which the price earnings ratio say that they're out of favor right now. And the growth funds are the stocks that are growing fast, often don't pay any dividends or very low dividends. And they've done well and they're going to keep doing well. At least that's the philosophy. And what usually happens is that growth funds, growth stocks that are doing well also do well next year. And it's called momentum investing, where you invest in what's hot because it's hot. And that holds true until it doesn't. And what happens is if you put all your money in what's hot, you end up getting whacked when there's a reversal. But growth, large cap, really big companies, growth stocks, companies that are growing and getting more and more revenue every year. Went to Investopedia and they had an interesting thing. Socially responsible mutual funds tend to have higher fees than regular funds. These higher fees can be attributed to the additional ethical research that mutual fund managers must undertake. The one that I showed you what it was holding, I don't know what ethical research they're doing to get Tesla, Apple, Microsoft, and all the Facebook, all the names that you know. It looks like they found a way to convince you through marketing to buy basically what is an index fund where they can make 2% on you every year instead of 0.1%, which in a way is kind of clever, but bad for you. The real problem, gets to the heart of social responsible investing. You are not helping. What you're doing is what we call this financial masturbation. You think you're doing something to help and you're not doing a fucking thing. As an example, what's it? Lockheed Martin. They make jets, bombs, all kinds of stuff like that. So you say to yourself, I'm not going to buy Lockheed Martin. Well, who the fuck are you? You're nobody. You not buying one specific stock, Lockheed Martin doesn't give a shit whether you buy it or don't buy it. And the funny thing is that when you buy a stock on the market, unless it's an IPO or a company sells shares out of treasuries, almost every time you buy a stock, you're buying it from someone else that already owns it. The price you pay or the price you get if you're selling it, generally speaking, of course, everything has exceptions, doesn't affect the company at all. You refuse to buy Lockheed Martin stock, whoop-de-dip-de-doo. Good for you. You took the moral high road, but Lockheed Martin doesn't give a shit. Now, you could argue successfully, I think, that if enough people refuse to buy Lockheed Martin, you could create a change in the supply and demand curve for that stock and the price would go down. Now, at some point, could it go low enough that the company would be worried and change their ways? No, I don't think so. Because long before you get to that point, there are going to be other investors who don't give a rat's ass about your moral virtue and not buying a military stock company. And they say, oh my God, even if they go bankrupt today, they have so much buildings and lands and patents and copyrights and future contracts that when they come out of it, this company is going to be worth more than this depressed stock price is. So they're going to buy it cheap. And when it goes up, if it goes up, they're going to make a whole lot of money and you're not. So you aren't having any effect at all. Odds are that the fund isn't really doing what you want it to do according to their own rules, which they can violate. The expenses are high. I mean, if you really want to do something to save the planet, to save humanity, invest wisely and scoop 2% of what you make every year and donate it to a worthy cause. You can find a women's shelter in your town, an animal clinic that rescues dogs that are about to be put down, teaching people how to read. There's an endless variety of things. And if you have $1 million portfolio and you scoop 2% off of that, you go to some small local charity and say, I want to give you $20,000. You're a goddamn hero for a local charity. You show up with $20,000. I mean, they're going to give you a tour. They're going to show you all around, and they're going to send you flowers or a fruit basket or something because you made a real difference to real people in your environment, in your city, in your town. And often I'll have people tell me, well, there's no fucking way I'm going to just give up 2% of what I make every year. You already are. I just showed you that data. You were giving up 2 to 3 to 5% of your money every fucking year because you got tricked. You were trying to do the right thing. I'm impressed with that. I know that your intentions were noble, but you're making less money than you could. And the people who are tricking you are making more money by tricking you. That's why they have so many of these funds, because people want to buy them. But the net effect is just a way to take more money out of your pocket, and it doesn't really help anybody in any way. So hopefully that answered it without me being too much of an asshole about it. So the summary here, every fund is different. You don't know for sure if the fund does or will do what you want. A lot of times mutual funds get sold. You know, one company has it, they sell it to another company. They can rename the fund. They can kill the fund. One of the problems with looking at historical data is mutual funds look better than they really are because, like, for example, Franklin Templeton did this and does it all the time, where they'll have 20 different funds, and out of the 20 US-based stock funds, 5 of them just suck. I mean, whoever was managing it fucked up. So what do? They roll those 5 shitty funds into the 15 of the halfway decent funds, and now they can say, hey, 13 out of our 15 funds are 4 or 5 star funds because they intentionally closed the really shitty ones. So they control the data. They control what you see. They can kill funds and hide their performance, and you never know about it. There's also companies that do what I call incubator funds, where they come up with 20 different crazy ideas. They seed each one of these 20 ideas with $1 million out of their corporate coffers. And at the end of the year, 4 or 5 of them went up 2, 3, 4 times. And so the other 15, 16, 17 get killed. You never knew they existed. It's like a psychic telling you they predicted something correctly. They made 40 predictions and 2 came true. Whoop-de-fucking-do. I can do that. But this company that has this incubator funds, they take the 4 that worked out of the 20 they created. 16 of them die. You never know about them. And the 4 get sold to you with a high commission because, you know what? Sure, the commission's 6%, but it's so fucking good. Look at what we did last year. And advisors all around the country will recommend that and sell those to people. Finishing point 3, you'll likely underperform the market. You're not actually doing any good. We talked about that. And then one more thing that I'll finish up, and I can always answer more questions or go back to the other topics if you want to be bored even longer. Books. People always say, yeah, Phil, you told me about all the shit. How do I do the right thing? You learn. If you're just new to investing or you can't figure out how to save enough, this is the starter book. And I'm recommending these 4. I have 4 books. You should read them in order. This book is old, like 100 years. It's out of copyright. I think you can even listen to it for free on YouTube. Somebody read it out loud because it's not copyrighted. The one little warning is this book is not woke. So if you get bothered by an author thinking that women shouldn't save or invest and it's a man's world, it also talks about your money and investments being your slaves, and your slaves give birth to more slaves. If that's really going to bother you, skip it. But if you can kind of work past that, it's really good about why you invest, why you save money, how you save money, and how you need to learn what the fuck you're doing So you actually get good results. The second book, A Random Walk Down Wall Street. And again, going with my philosophy of not trying new things, you will notice that all of these books are not from the last couple of years. This one, actually, I think this is the 7th or 8th version. There's another one coming out in a few months, which is great. I'd hold out and make sure you get the right version. Originally came out either in the late 60s or early 70s. And every 5 to 10 years, they revise it. They add new content, they fix errors, they make it better, better and better and better. And this is a great book for people that really, they read the first book and now they're like, okay, I know why I need to save and I know I need to learn how to save. Well, this is the book that fucking does that. It's going to teach you what a mutual fund is, what an index fund is, what an ETF is, how to invest, what a put and a call is, a lot of stuff that you may not need to know, but it covers it. Why mutual funds are good, why some are awful. Absolutely fantastic. Third book, Winning the Loser's Game. This, of course, builds on the first 2 books. So if you don't know a lot of the nomenclature and the words in the investing world, you can still read this book. You're just not going to get a whole lot out of it. And this talks about the philosophy of, instead of trying to beat the market, how can you match the market? Because you're a nobody, you're a loser. And if you try to compete with all the people that maybe have gamed or fixed the system and it's hard for you to beat them, okay, don't try to beat them. Just try to not lose. Try to match them, try to match the market. And so it's a good summary of some of my philosophies on how one can perform well. I think that maybe this one is the 7th edition, the 8th one is coming out. And again, I think this was first written in the early 70s. So almost 50 freaking years. Because I don't want a book that's got a hot new idea that may or may not work. I want a book that's been around for 50 fucking years and it's got good information in it. The fourth book, the first 3, you can read it on Kindle. You can get an audiobook, whatever method works for you. You can get paperback, hardback. But the 4th book, which is this one, Common Sense on Mutual Funds, I insist that you buy it in physical paper format. I insist that you treat it as a textbook because it's fucking complicated. It's got a lot of advanced ideas. If you're new to the investing world and you start with this book, because I've had people do it, they go, I'll just skip to the end. They read the book and go, I don't even know what the fuck I read. Yeah, I told you that's what was going to happen. This book is filled with data, tables, graphs, charts, sometimes even some complex mathematical formulas. And it really breaks down and explains why index funds do so well and why that's probably not going to change. But it can be intense. It can be a lot to read, especially if you start with this. But like I said, it's not a race. This is not a Harry Potter book. This is not something you're going to pick up and read in 6 to 8 hours. At least I don't think you should. I think you should read a section. And sometimes I'm talking about 2 or 3 pages with a thesaurus to look up the words, or a dictionary to look up the words, with the internet browser open so you can go, I don't know what this word is, and you can look it up. Highlight, write in the margins, dog ear the pages, put in post-it notes so you know to come back to something. Do whatever you got to do. Take 6 months, take 12 months, take 18 months. This can be something that helps you learn how to invest for the next 10 to 20 years or 50 years if you're 20, maybe even longer. You're not going to learn it all in one day. It's just complicated shit. But I consider this book to be my Bible. And from time to time, if I'm stuck with something, I don't know what to cover, investments on the show, I'll just flip through the page, just put my thumb in on a random page and go, oh, God damn it, this is a fascinating topic. And now I know what I'm going to talk about. So those are books you can read. Of course, thank you for listening to me ramble on. I can take more questions. I know, the 20 to 40 minutes that Evan suggested is now gone. So hopefully somebody gets value out of this. Like I said, you can email me, phil@polarisfinancialplanning.com. I am a talker. So if you want to email me and talk about something, I'm not really going to probably give you a very good written response because I fucking never learned how to write properly. I'm a victim of the American education system. But if you give me your phone number, I'll call you. If you're available, then we can talk. If you're not, we can set up an appointment. There's no cost. There's no charges. We can talk about ideas. You can eventually send me your portfolio if you want me to critique the things that you own, but be prepared for a straightforward and honest critique. If you have some flaming piles of shit in your portfolio, I will tell you that, and then you'll be on your own to go do what needs to be done or to ignore me. That's cool. No obligation. Remind me that you saw me here just so I know where you came from, but no obligation, no costs, no fees, no hourly charge. If you want to talk, a little bit more, maybe we can do that. But if you want to call me every day for a month and not hire me, fuck off. It's just not going to happen. So I've got my limits. Other questions, Evan, you got anything?
Yeah. We've got I got two big questions. One, when you were talking about the ethical funds, someone was asking about tobacco stocks, and wasn't that part of what took down tobacco stocks?
I have no evidence. I've not seen evidence, and I'm not saying it didn't happen, but I'm not aware of socially responsible mutual funds avoiding tobacco stocks causing their price to go down. And like I said, if the value of the company did not change in any way and just the price of the stock went down, even if you could document that that's what happened, eventually someone who doesn't give a shit about your philosophy is going to buy the stock and make a ton of money on your sacrifice. Good job.
And then there was a question about how do you choose a good investment advisor? What's the difference between an investment advisor and a financial advisor?
So this is one of those things where financial advisor, investment advisor, money manager, a lot of words like that, they are absolutely meaningless. There is no regulation whatsoever. Anyone can call themselves whatever the fuck they want. It's been kicked around. The only thing couple things that matter. One is if a company is an RIA, registered investment advisor. That is a very specific legal definition, and you'd have to be registered with the state or the federal government. I myself am an investment advisor representative, which means I work for an RIA. Those have legal and very real meanings. And if you say that you're a registered investment advisor and you're not, probably penalties because it's a white collar crime, but theoretically you could go to jail. The other thing is to ask about the word fiduciary, which even though I've been doing this for 25 years, I almost always say it wrong. So I have to pause. You want to ask your advisor if they are a fiduciary, and will they put it in writing? And are they a fiduciary all of the time, 100% of the time? And kind of think of it as your attorney. If they say, no matter what you tell me, attorney-client privilege, you can tell me anything and I won't rat you out to the cops unless you actually murdered your wife, and then I'm going to go tell them. Well, if you don't keep everything I said secret, how do I know in advance what you will and won't keep secret? Then you don't have attorney-client privilege. And so if the advisor says, oh, yeah, that's really important. So for the mutual funds, I'm definitely a fiduciary, but there's other things that you should have in your portfolio, like a core of any good portfolio is an annuity. Well, then they can't really act as the fiduciary with the annuity because of the way the commissions are paid on that product, which is not possible. But I see people doing that all the time where you'll ask somebody if they're a fiduciary. It used to be that they would go, what? What does that even mean? Or no, that's not important. Well, now they lose clients because of that. So they'll say yes. And unfortunately, they might be lying to you. So you're going to have to ask for it in writing. And you might want to get a second opinion from somebody. But if they suggest things that seem odd, things that you don't understand, tell them no. Not until you understand what they're recommending. Because it's not just annuities. They could put you in a thing called a private placement REIT, where they'll tell you, you make stock market-like returns, but you have bond risk levels. Who the fuck makes something like that? That's not how the world works. Another one, master limited partnerships. Any limited partnership is out, but master limited partnerships where your money is used to invest in pipelines that make 90% of their money from transportation of oil or natural gas. And you might think to yourself, well, that's a weird thing. Yeah, it is. Congress at some point made a specific law carving out this type of company, master limited partnerships. One of the fun things about master limited partnerships, they don't have to use GAAP protocol for accounting. That's generally accepted accounting principles. They don't have to follow those rules. They can use different accounting rules to evaluate the company. I mean, so you might as well be buying a Chinese stock. You have no way of knowing that the number they're telling you is worth anything. Any investment that's not publicly traded scares the shit out of me. I just had someone hire me that bought, what was it? Preferred stock, which I'm generally not a fan of either, but occasionally you could find something if you did a lot of research. If your broker calls you and goes, hey, I got this preferred stock that you want. Why are they telling you to buy this preferred stock? Because they're making a commission. That's why they're buying it. Even worse, they may not be making a commission, but the brokerage firm may actually own this. So they're not acting as a broker. They're acting as a dealer. So they're selling to you from their own inventory, and they don't have to disclose how much the markup is. They can make 20% on the shit that they're selling to you. And it may take you 10 years to break even. They don't have to disclose that because they're the dealer. They're selling for themselves on their behalf to you. I don't know, just there's an endless list of ways to separate you from your money. But ask if they're a fiduciary, I guess, short answer, sorry. And ask for it in writing, because at least then you've got a better shot. If it's not publicly traded, you don't want it. Oh, that's what it was. Someone bought preferred stock that when they hired me, I wanted to transfer it over to TD Ameritrade, the qualified custodian that I use for my clients. TD Ameritrade said, we can't hold this. It exceeds our risk profile. I'm like, what the fuck does that even mean? And they're concerned that if they hold it on behalf of a client, they may be stuck holding the bag because there's no way for them to value what that thing is actually worth. So the client had to sell it where they were and pay a 10% penalty for getting out early. Anything that has a penalty to get out early is probably a bad investment, because if it's a good investment, you're never going to leave. You're just going to make money. Why the fuck did I have to charge you 10% to get out? Because they don't want you to go. I'm sorry, I'm rambling. What else you got, Evan?
Yeah. There was one question about, it was relating back to the Fed and it's the Fed electronically creating money and using it to buy back bonds. I'm thinking about how this might affect inflation. It's another inflation question.
Yeah. It's definitely a possibility that when you increase money supply, and it has been increased materially, ask any Bitcoin fanatic. They'll tell you how much money the Fed is literally printing, creating out of thin air. The first question, of course, is that even a bad thing? Do you want a government to be able to increase money supply when there's a recession? Do you want them to be able to provide money for people that may lose their home or can't eat? I don't know. I mean, it may be a political, philosophical question about whether they should do that or not should do that. I think as a whole, the government having control over the money supply, when used correctly, mostly correctly, not always, it's government, it's people, it's humans, they fuck shit up. I think monetary policy as a whole is a good thing, because without some kind of monetary policy, when things start going down, you get runs on the bank because there's no one backing up the banks. Just like I noticed the other day, Bitcoin went from $62,000 a unit to $54,000, went down 20% in a day. I don't know why. I don't know if anyone knows why. Before it went from 20,000 to 3,000 or 4,000 in a year. Why did it do that? I don't know. People didn't want it. People sold it. There was more sellers than buyers. There's no intrinsic value in a Bitcoin. And the idea that Bitcoin eventually in the year 2160 has a limited supply is silly. And Elon Musk taking Tesla's money, $1.5 billion, and buying Bitcoin is obscene, in part because Tesla goes forward on this idea that they're going to save the planet by making electric cars more efficient, energy efficient. And there's a lot of truth to that. But Bitcoin is grotesquely, absurdly inefficient. The amount of electricity that is used around the globe is probably more electricity than a country like Venezuela or Mexico uses for its entire fucking population. it's really bad for the world, on top of being a really shitty currency and not an investment. That's also another thing that's gambling, by the way. My opinion, you asked.
Cool,
Maybe in that
cool.
case you didn't ask.
All right, we have, let's give you this one last one
Yeah.
before we call it. But what are some other examples of common pile of shit investments that people fall for?
I know one that's going around is called Fundrise, where you can invest in real estate like a millionaire or a billionaire can, and you get to buy parts of an entire building. It might work out for you, but it might not. There's no way to know in advance. Often those things will have a phrase like the shares, if you decide you want your money out, which is a problem, the shares are redeemable, but it might mean that once every calendar quarter, 2% of the assets can be redeemed. And so when the real estate market goes south and you figure out that your investment just went down 20%, and you apply through a 15-page document, which, you fucked up. You marked one box wrong, so now you don't even get to go in the pool. But if you put everything correctly, and 10% of the people want their money out, they're only allowing 2% to leave. So you got a 1 in 5 chance of getting your money out that quarter, and you've got to apply the next quarter and the next quarter. And that's technically redeemable. You just didn't meet the qualifications to redeem. And so anything that traps your money is bad. And like I said, if you start with from the default idea of, if you don't know exactly how it works, if you don't fully understand it, don't fucking buy it. It's one of those things. What's the phrase I like to, have you ever known anyone that is always trying to strike it rich? Did you ever notice they're always trying? I mean, if striking it rich worked, they wouldn't keep trying to strike it rich, because one of the schemes would have worked. It can be really boring. Buy and hold, buy and hold. If you save 10 or even more preferred 20%, of course, if you can do more, the better for you. Investing long-term in stocks and bonds, if you wait, if you invest enough and you have enough time, you will be rich, but it's not going to happen overnight. And that is not very exciting for a lot of people. So they want stonks. Apparently they want stonks. I gotta find something that is going to be manipulated, something that's going to be a trick, and I got to get in before other suckers and then promote the fuck out of it so I can get my money out. It's not investing. That's a game. And you might make money at it, but it's not investing, in my opinion.
Okay. Well, thank you. I'm going to end the live stream right now. For any of you looking to get some tax relief, I highly recommend Atheists United, among other incredible organizations. But yeah, we really appreciate you attending this event. This is one of our 3 speaker series that we host each month. This is our pop-up speaker program. And yeah, we want to keep doing these for many years to come, including launch a lot of the other new programming we've been launching. So please consider a gift to Atheists United. Thank you. I'm going to end the live stream now, and yeah, people can unmute themselves and hang out for a bit if Phil's willing to